Welcome to Griffonomics. Imagine intentionally tearing down your own business, burning nearly $57 million in a single quarter, and just flatlining your revenue.
Sounds like a terrible idea, honestly.
Right. But doing all of that on purpose just to secure the keys to the Pentagon's classified networks. Today, we have a mission that breaks down exactly how that happens.
It is a wild strategy.
It really is. We are generating a granular strategic report and investment roadmap exploring BigBear.ai. They trade under the ticker BBAI, and we're looking at their massive Q1 2026 transition.
Yeah, they were right in the middle of this high-stakes pivot.
Exactly. Shifting from a legacy, labor-heavy consulting firm into this high-margin, mission-ready AI software business. And to get to the bottom of this, we are pulling from a heavy stack of sources today.
We have the data to back it up.
We do. We've got the Griffonomics High Stakes Pivot Report, their Q1 2026 financial disclosures, all those SEC filings, including the 10K and 10Q, and the latest earnings call transcript.
And for you listening, understanding this pivot is absolutely essential because AI investing is moving past the hype phase.
Yeah, the shiny object phase is over.
Right. The market is done just talking about potential and shiny new chatbots. This deep dive is really about how a company actually re-engineers its financial and operational DNA to survive and scale in the cutthroat worlds of national security and global trade.
Which is not easy.
No, it is a messy, highly technical process. But this granular level of operational surgery is where actual long-term value is built.
And to understand just how messy that surgery is, we need to start with the most glaring paradox in their Q1 financials.
The revenue numbers.
Yeah, if you look at the top-line revenue for Q1 2026, it is completely flat. $34.4 million, basically no growth from the year prior.
Which normally would be a massive red flag.
Exactly. And alongside that, they posted a massive $56.8 million net loss, paired with a negative adjusted EBITDA of $9.9 million. Yeah, and for context for the listener, negative adjusted EBITDA means the core engine of their daily operations is bleeding cash before you even factor in the accounting noise of things like taxes or depreciation.
So they're burning cash.
Burning cash.
Wow.
So on the surface, you have stagnant sales and a burning cash pile. But at the exact same time, their profitability metrics are drastically improving. It's like renovating a house while you're still living in it. They are intentionally shedding lower margin, labor-heavy, legacy U.S. Army consulting programs to make room for high-margin software.
What's fascinating here is the underlying mechanism driving that paradox. It is a deliberate structural swap.
Right.
Think of the difference between running a bespoke tailoring shop versus building an automated factory.
Okay, I like that analogy.
In the legacy consulting business, the tailor shop, every single project requires hundreds of hours of manual billable labor. You have to hire a new person for every new hour you want to build.
Which makes scaling incredibly expensive.
Exactly, and the margins are painfully thin. So they are shutting down that tailor shop to build an automated software factory. Building the factory costs a fortune and halts your current revenue growth while you transition.
But once you turn it on,
you are stamping out identical software infinitely with almost zero marginal cost.
which perfectly explains the sheer mathematical payoff we see in the Q1 data. When you shed those heavy service contracts, it hurts the aggregate revenue number, but the profit on what remains just goes through the roof.
The margin expansion was incredible.
Staggering. A 12,278 basis point expansion in gross margin in a single year. It rocketed from 21.3% in Q1 2025 to 34.0% in Q1 2026.
Which is huge.
For anyone unfamiliar with basis points, that means their profit margin on the cost of goods sold leapt by nearly 13% in a single 12-month window. In the corporate world, a 2% jump is a victory. 13% is an absolute earthquake.
And that earthquake signals to you, the listener, that the fundamental quality of BigBear.ai's revenue has fundamentally changed.
They're selling totally different things now.
Exactly. They are successfully swapping out those unscalable, billable service hours for highly scalable technology contracts. And the market is responding to that new factory.
Right, the backlog.
Yes, that strategic swap is exactly what drove a 14% sequential increase in their total backlog, bringing it to $281.9 million. They are building a pipeline of high-quality, highly profitable work, even if the top-line revenue hasn't exploded quite yet.
Okay, let's unpack this, because if they are shedding their old business to sell software, we really need to understand the actual product driving these massive margins.
Ask Sage.
Right. all the sources point to this one major catalyst, Ask Sage. This is a generative AI platform they acquired, and the reach is already incredible. The data shows it is being used by 16,000 government teams and 100,000 Department of War users.
It's massive adoption.
But here's my issue, though. When you dig into the SEC filings, it specifically says Ask Sage has a no-vendor lock-in architecture. It acts as an orchestrator that takes user prompts and routes them to hundreds of different foundational models.
Models built by other companies.
Right. Models built by other tech giants. If BigBear.ai isn't even building their own underlying AI models, they are essentially just a middleman. How is being a middleman a sustainable competitive advantage?
It sounds entirely counterintuitive, I know. Especially when we are conditioned to think the company with the smartest proprietary algorithm always wins.
Right. We always think of the model itself as the product.
But in the defense sector, being a highly secure, platform-agnostic middleman is actually the ultimate strength. Think about an intelligence operator working in a classified facility.
Okay.
Their primary concern is not whether they are using the absolute smartest new algorithm from Silicon Valley. Their primary concern is absolute security. Ask Sage guarantees zero data leakage.
So they don't leak secrets back to the public model.
Exactly. It allows a government user to access the processing power of the best commercial models in the world without ever risking that their classified data will be absorbed, memorized, and used to train a public commercial model.
Oh, wow. So the moat isn't the AI itself. The moat is the regulatory fortress they built around the AI.
Let's look at the clinical rationale for that fortress. Ask Sage is the very first Gen AI platform to achieve FedRAMP authorization, alongside Department of Defense Impact Levels 5 and 6, so IL-5 and IL-6, as well as top secret clearances.
That sounds like a lot of red tape.
It is, and these are not just administrative rubber stamps. Impact Level 6 means the software is authorized to process information classified up to the secret level.
Wait, secret level? That's intense.
Extremely. Achieving those certifications takes years of brutal adversarial auditing by the U.S. government. They scrutinize every single line of code, every single data pathway.
So nobody else can just swoop in.
It is an impenetrable barrier to entry that completely locks out newer commercial AI startups.
Yeah.
A hot new AI company with a brilliant model cannot simply walk into the Pentagon and pitch their software because they do not have the clearance to operate on those classified networks. BigBear.ai does.
And the Q1 data provides the ultimate validation of that moat, because BigBear.ai secured a massive $53 million sole source classified award with an intelligence community customer.
Sole source is the key phrase there.
Yeah, meaning the government didn't even open the contract up to competitive bidding. They went straight to BBAI. But the real headline hidden in that contract is that it establishes BigBear.ai as a prime contractor.
And the shift from subcontractor to prime is a massive paradigm shift for their operational leverage.
Why is that so important?
Because in the defense world, being a subcontractor means you are essentially taking orders from the massive legacy defense giants. You get squeezed on margins, you have no direct control over the client relationship, and you are entirely dependent on the prime winning the bid in the first place.
You're just along for the ride.
Exactly.
Yeah.
Ascending to prime status means the U.S. government is cutting the check directly to BigBear.ai. The intelligence community now trusts them as a primary AI orchestrator. They are no longer taking orders, they are dictating the terms.
But there is a fatal flaw here, right? If you rely entirely on the Pentagon and the intelligence community, defense sales cycles take years.
Very true.
From the initial pitch to the rigorous testing, the budget approvals, and the final payout, you are looking at a brutal 12 to 18-month waiting game. If BBAI is going to survive the heavy cash burn we discussed earlier, they need to prove this technology can scale quickly in the commercial sector.
That reality is exactly what is driving their second core target market, the trade and travel pillar. They cannot wait on the Pentagon forever.
And the sources highlight something very specific here: the deployment of biometric technology, specifically the Veriscan and TrueFace platforms they acquired via a company called Pangiam at Chicago O'Hare and Dallas-Fort Worth airports.
Right. Major international hubs.
Yeah, and these are combined $7 million contract wins. Now, in the grand scheme of a $281 million backlog, $7 million seems like a rounding error. It doesn't sound like a company maker.
It might not transform the balance sheet overnight, but the strategic proof of concept is immense.
How so?
BigBear.ai is taking national security-grade vision AI, the exact kind of technology used to identify high-level threats at a militarized border, and proving it can create frictionless, rapid user experiences in a chaotic commercial setting.
Like an airport terminal.
Exactly. They are proving commercial scalability. If your AI can securely and rapidly process thousands of impatient moving passengers through a bottleneck at O'Hare using facial recognition without causing delays, you can scale that identity verification tech to almost any enterprise on the planet.
And connecting the dots on their M&A activity makes this vision even clearer. In January 2026, they also acquired CargoSeer, an AI company focused entirely on customs and border operations.
Supply chain analytics.
Yeah, it provides analytics to predict which shipping containers need physical inspection based on complex risk profiles.
When you put Pangiam's passenger biometrics together with CargoSeer supply chain analytics, a holistic strategy really emerges.
It's all connected.
BigBear.ai is aggressively capturing the entire spectrum of global movement. Whether it is a shipping container moving through customs, a passenger walking onto an international flight, or a military asset crossing a border, they want their AI to be the invisible infrastructure verifying and orchestrating all that movement.
Here's where it gets really interesting, though. Funding that massive vision requires serious capital. Acquiring Ask Sage, acquiring Pangiam, acquiring CargoSeer, none of that is cheap.
M&A is incredibly expensive.
And we already established their core operations are running a negative EBITDA, burning nearly $10 million a quarter. So the immediate question is how a company with flat revenue affords this aggressive shopping spree.
You have to look at the balance sheet.
Right. You look at the Q1 balance sheet, and suddenly they are sitting on $431.5 million in total liquidity. It is an enormous cash pile. The analytical challenge is determining, did they just sell off the family silver to pay the mortgage, or are they gearing up to buy the neighborhood?
To unpack that, we have to do some forensic deleveraging work on their Q1 financial engineering. They had $124.6 million in convertible notes looming over them, scheduled to mature in 2029.
Okay, convertible notes. Explain that real quick.
These are essentially loans that could eventually convert into equity. Instead of bleeding cash through interest payments or paying that principal back, they executed a voluntary debt-to-equity conversion. Management convinced the note holders to take shares of stock right now instead of cash later.
Wow.
Because of that aggressive move, total debt on the balance sheet plummeted from over $140 million down to a minuscule $17.7 million. The downstream effect on their cash flow is incredible. Their interest expenses dropped by 93.8%.
That is massive.
They paid a mere $317,000 in interest for the entire quarter.
That is undeniably a masterful cleanup of the balance sheet. It dramatically lowers their risk of bankruptcy. But it sparks a massive polarizing debate among analysts. Let's look at the bull case first.
The optimistic view.
Right. For the optimist, this $431.5 million in liquidity is a literal war chest. By wiping out the debt and eliminating those crippling interest payments, CEO Kevin McAleenan now has total strategic freedom.
He isn't worrying about making a debt payment next month.
Exactly. He is actively looking at the market to see what other high-margin software platforms he can acquire to accelerate the factory we talked about earlier.
The bear counter-argument, however, focuses on what we can call the dilution reality.
Yeah, because that cash didn't just appear out of nowhere.
No, it didn't. To get that beautifully clean balance sheet and that massive cash pile, BigBear.ai had to flood the open market with shares. They issued over 180 million brand new shares.
Where's 180 million?
More than 142 million of those came through ATM or at-the-market offerings.
Right, and for context, an ATM offering means a company isn't doing a heavily publicized secondary stock offering with a big Wall Street roadshow. They are just quietly dribbling shares into the open market, selling them at whatever the current trading price happens to be.
Exactly. And another 38.1 million shares were issued specifically to settle that debt conversion we just talked about.
So if you are an existing shareholder who believed in the company early on, your slice of the pie just got dramatically smaller. Your ownership was severely diluted to fund this transition.
And the bears make a compelling point regarding the government sales cycles.
Yeah, taking over a year.
Right. With those intelligence community contracts taking well over a year from pitch to payout, that $431 million might not be a war chest for acquisitions at all. It might simply be a necessary safety net required to survive the massive quarterly cash burn while they wait for the government bureaucracy to finally release the funds.
Both the bulls and the bears are looking at the exact same numbers, at the same 34% margin, the same 180 million new shares, and drawing wildly different conclusions about whether this company is aggressively expanding or merely engineering its own survival.
It really depends on your timeline.
So, what does this all mean for governance? because that sheer volume of new shares creates a fascinating secondary problem. When you drop 180 million brand new shares into the public market, your shareholder base radically changes.
You suddenly have a vastly expanded base of retail investors.
Right, everyday people trading on apps like Robinhood. Management has to figure out how to maintain control of the company's direction when the voting power is suddenly scattered across thousands of individual retail accounts. And the Griffonomics report highlighted a very specific, almost hidden mechanism they are using to address this called a voluntary retail voting program.
If we connect this to the bigger picture, the mechanics of this program are a brilliant piece of corporate governance strategy, even if some view it as highly controversial.
Because everyday retail investors notoriously do not vote in shareholder meetings.
Right, they ignore the proxy emails sent by their brokerages. The board of BigBear.ai recognized this and decided to actively harvest that digital apathy.
Harvesting apathy, that's a phrase.
They created an automated program where retail shareholders can essentially opt in to pre-align their future votes with the board's recommendations. If the retail trader doesn't actively log in and vote on a specific issue, their shares are systematically routed to vote exactly how management wants them to.
Wow. It transforms a scattered, apathetic retail base into a concentrated voting bloc controlled by the board.
And you see exactly why they need that concentrated voting block when you look at Proposal 5 from their recent proxy statement.
Oh, Proposal 5. This is where they propose doubling the total amount of authorized shares from 500 million to 1 billion. Now, looking at this completely impartially as an operational mechanism, the proxy itself explicitly notes that authorizing this massive pool of new shares has a potential anti-takeover effect.
That's a classic defensive entrenchment tactic, often referred to as setting up a poison pill.
Right.
By legally authorizing another 500 million shares to sit in reserve, the board holds the power to instantly dilute any hostile activist investor who might try to buy up a controlling stake in the company.
So if an activist tries to stage a takeover,
The board just floods the market with new shares, completely destroying the activist voting percentage. It effectively blocks outside interference.
you can view it as management fiercely protecting their long-term AI strategy from short-term corporate raiders who might want to sell off the parts. Or, you can view it as management aggressively insulating themselves from shareholder accountability.
Both interpretations are valid.
But strictly from an operational standpoint, it ensures the current executive team maintains absolute control over this massive, messy pivot.
And bringing all of these threads together, we have to synthesize the two very distinct realities of BigBear.ai's high-stakes pivot.
Yeah, on one side of the ledger, you have a company that has successfully engineered an incredible 34% gross margin by tearing down its legacy consulting business.
They're sitting on a $281 million backlog of high-quality software contracts.
And they have built an impenetrable, heavily regulated moat that has elicited them to a prime contractor for the U.S. intelligence community.
But that undeniable progress must be weighed against the heavy gravity of the transition itself. They still suffer from stagnant aggregate top-line growth because the old business is decaying just as fast as the new software business is growing.
And they secured their financial survival and that massive $431 million liquidity floor only through massive shareholder dilution.
They are at a true inflection point between realizing the profits of their new automated factory and outrunning the cash burn it took to build it.
As we wrap up this deep dive into the DNA of their transition, there is one final underlying dynamic regarding their core technology that the sources raise, and it really leaves us with a critical question to think about.
It is something for you to closely monitor as this company's strategy unfolds over the next few quarters. If BigBear.ai's entire competitive strength and regulatory moat relies on a no-vendor lock-in architecture, a system where they orchestrate other people's AI models but don't actually own the foundational technology themselves, what happens to that impenetrable moat if the intelligence community eventually decides to build its own proprietary in-house foundational AI?
Oh, that's a great point. Does the platform-agnostic orchestrator suddenly become obsolete?
Or does navigating the sheer complexity of future AI make a highly secure, prime-authorized middleman more essential than ever?
Risk defined, portfolio protected.